Hi, welcome back for day 5 of the Market Volatility Survival Guide. We're capping off this week-long series here today on Friday, March 27th, with the most important thing, it's the most exciting segment, in fact, of this whole series. It's the strategy session. I want to share with you some practical steps you can be taking right now in your portfolio. But first, let's recap what we covered so far this week. I started off with the reality check, recognizing this is a very scary environment for most of us and that we've seen investment portfolios be really badly damaged because of the sell-off. But also what I said is the big picture is that in every crisis lie the seeds of opportunity. I shared with you the perspective that some of the best investors of the world see this as a once-in-a-decade opportunity, and in some cases, once-in-a-multi-decade opportunity. I told you as well that the road ahead is that we are attacking this crisis with a three-pronged approach. We've got the healthcare response, we've got the fiscal response with this massive stimulus now coming online, and we also have the monetary response from the Federal Reserve basically saying, we've got a blank check. We're going to deal with this and we're going to come out better in the end. I told you yesterday about this massive force pushing stocks higher over the last 3 days called rebalancing, where institutional investors are buying depressed assets, bringing their asset allocation levels back in line. So now let's talk about where the market is today. I told you that we should not expect to see a V-shaped recovery. So today the market is stepping back. Indices are down about 3%. But yesterday I said the S&P 500 could hit a ceiling of resistance and we could trend down from here in the short period. I said, in fact, 2,600 to 2,650 is where I would expect that resistance to come in. And yesterday we closed at 2,630, right in the middle of that range. What we expect is that we may not see the bottom of the sell-off until we see the headlines at their worst. And that may be a month or two away, okay? So what we want you to do is to take some very specific step-by-steps to help work your way out of this crisis and to improve your portfolio. Step number 1 is rebalancing. So today we're actually buying in our client portfolios, adding back some stock exposure to take advantage of today's sell-off and these low price levels that we're currently at. But also I want to tell you that all of our clients have a maximum level of risk in their portfolio that we're willing to take, and right now we're sitting way below that. It's like if this is 65 the speed limit, we're down here at 40. How did we get there? Well, because of both market declines, but also manual steps that we took to reduce risk over the last couple months. So the opportunity number 1 is bring those risk levels back up over time so we can take advantage of low-priced assets that we can be buying today. But step number 2 is we don't want to do that all at once. I can't tell you, as I said, that we've seen the lows. The prices that we're going to be seeing in the future could be lower than they are today. So this involves a very good tool we want to use today called dollar cost averaging, systematically investing the money that we want to be adding back into the markets over a period of time to take advantage of the possibility the prices could be lower in the future. It's a very disciplined, very useful tool. The third thing is that we see an opportunity here for investors to benefit possibly from more active management in their portfolio. Our client portfolios are constructed primarily using index funds and ETFs. So when we see the indexes are down 20%, we know that many individual stocks are down a lot more, and there may be an opportunity for us to benefit from. Here's an example. The S&P is off about 20% from where it began the year. If it gets back up to where it began, that's not a 20% gain. It's about a 25% gain. We see stocks that are down way more than that, though. I looked at every single stock in the S&P 500 last week, and many of them were down 50 to 75% or more. It's as if all of these companies are going out of business, but they're not. Many of them are going to survive and also thrive, in fact, coming out of this crisis. So if a stock that we buy that's down 30% regains that loss, that's not a 30% gain, guys. That's a 42% gain from those levels. And a stock that's down 50% getting back to where it was is a 100% gain. So here's an opportunity where it's appropriate for individual investors to shift money from that passive part of their portfolio, perhaps a piece of it, into an actively managed individual stock portfolio. And we have one of those, our select equity portfolio. Now, this is not going to be appropriate for everybody. This is not a blanket recommendation by any means. I want to tell you, we really want to make sure that we're talking individually and considering what's appropriate in your own situation. Most importantly, during this period of economic upheaval, we want to make sure that everybody has ample cash for reserves and to get you through a period of job interruption if that's something you're facing. We're here for you to be a proactive guide, but I want to thank you all for taking the time to listen to me, not only today, but throughout this week. I've gotten a lot of great feedback from everybody that's listened in. We've gotten introduced to some new people that didn't know us before, and I've talked to a lot of clients that really appreciated us helping them through this period of nervousness that they were feeling. But also we have a lot of clients now telling us, hey Brad, this is a great opportunity. Thank you for pointing it out. We want to take advantage of it, and let's put some money to work. I'm Brad Levin. Thank you again for watching. We'll be back soon.